Kate. Yeah, welcome. So my name's Ben, and can everyone just in the chat, if you could just let me know, make sure that this is coming through okay. Anyone? Yeah, perfect. Okay, great. Yeah, so today we're talking about how to be smarter with tax in 2021. I found that the new year is a time that does get a lot of people pumped up, thinking about their money, all the things that they can do. But it's not easy. There's so much information out there that it's sort of like, it's hard to know, how to get started. So this series this is actually the 4th event in a 6-event series that we put on in partnership with General Assembly and the legends over at Raise Invest to get really practical. And today we're going to be talking about some of the practical stuff that you can do to get on top of your tax. We pay a lot of tax in Australia, so any money that we can, tax is obviously important, but any money we can save, we can direct to our asset building investments and wealth creation, ultimately creating financial security. So yeah, so we'll jump into that. Look, guys, before I do though, please don't rush out and make any life-changing decisions off the back of the content that we cover today. I'd strongly encourage you to seek advice before jumping in. You should be doing that anyway with talking about some important stuff here. So look, I suppose, before we get into the specific sort of tax stuff that, that there are, I know that everybody's situation is unique, but there are some fairly common challenges when it comes to tax and to money as well, more broadly, that, and I've got them up here. The first is information overload, that it's, there's everything is just a keystroke or 20 away these days, but it's almost like we're drinking from the fire hose. It's hard to know who to listen to, who to trust, especially in the tax space. A lot of conflicting points of view, mixed messages, but hidden agendas, and that conflict can really, the overwhelm is real. The second one that I've got here is that people really struggle to find a balance between making smart financial decisions, but then to be able to get ahead and live the lifestyle that they want as well. And the third one, this is FOMO, which everybody knows, which is the fear of missing out. But the FOFU, which I'm about to trademark actually, which is basically the fear of fucking it up. So it's when we're making these bigger decisions or setting the direction or the pathway that we're taking, that the bigger the numbers get, the more scarier it is to make those decisions on our own. And ultimately, those three problems combine to lead people to get stuck. And you're stuck, not always stuck doing nothing. Sometimes you're just stuck doing the same thing that you've been doing in the past. But what that really means is that you're missing the opportunity to be getting better results, to be getting more out of what you've got now. So this is, I suppose, not really something that we're going to get into in a lot of detail today, but just as an FYI, that there are 3 elements that you need to get right to be successful with your money, which is what I've got here: structure, strategy, and solutions. And structure is about making it easy to save and manage your money. Super important. Making it really clear. Structure is also about making it really clear what money you've got to work with when it comes to, saving strategies, debt reduction, whatever. This is where the tax can help with creating a bit of cash there. For that. And then the next element is strategy, which is about understanding where you're headed, getting clear on the pathways that can get you there, wrapping it together into a clear action plan. Importantly, that you've got the lifestyle things that you want to do factored in, so that you've got the things that you absolutely want to have the ability to do if you choose to do them, that you've got them mapped in. And you importantly looking to make sure that when you're making financial decisions, that your financial decisions fit with the lifestyle baseline, or the lifestyle that you want to have the ability to do moving forward. So, and then the third element that I've got here is solutions. So investments and product solutions that back up your strategy. And I am going to talk a little bit more about investments today, because investments are they're one of the areas that really drives really drives your tax outcomes. And in fact, to say it a different way, that one of the biggest ways that you can save tax in Australia is by making sure that your investments are set up in a tax effective way. So I'm going to talk a little bit more about how we do that. And sorry, just going back to just to wrap on these elements, that with the three things that are there, if any one of them is missing, that they end up dragging down the others. So it's important that you get them all right. You know, if you're missing a good structure, it's like you're working with a leaky bucket. If you're missing a good strategy, then you're leaving money on the table. And if you don't have good investments, then you end up blowing up your cash. Doesn't matter how good your strategy and your structures are. So it's the power of the three together is much more than any individual element. But it's also, if anyone is missing, that it's impossible to achieve real financial success. So important to focus on. As I say, we're talking more specifically about tax today, but when you're thinking about the new year, I know a lot of people get really pumped up and motivated, and you know, it's an exciting time. It's great. You know, for us, we get a lot of people, you know, I think we've got 1,000 people sort of registered today for this session. We've got, you know, we tend to get pretty busy with people at this time of year. But the unfortunate thing is that we see a lot of people that lose the momentum and don't take advantage, and then they end up in exactly the same position next year. And thankfully, some of them, they'll come back to us and we end up, you know, getting on top of stuff, but they're all sort of kicking themselves saying, we wish we would have done it at the time. And so for you guys today, as we're going through the content, think about, you know, the practical steps. I'm going to focus on the practical, you know, the actions and the stuff that you can take, but walk away so that you know that exactly what you're going to do, because great ideas are fantastic. And hopefully you get a bunch of those today, but we need to translate those ideas into actions, because it's only really action that's going to give you the results. So that's my way of background. But look, in terms of tax, the basics of the tax system, first of all, then I'm going to get into some more. We'll talk a bit about tax with investments and then the tax planning strategies. But, you know, firstly, we work in a marginal tax system in Australia. So, and what that means is that that our tax, the higher our income is, that the more that we earn, the more that we pay tax, but only on the extra, the income above certain levels. So just to bring up, and I've got the ATO's tax brackets here, that we've got, you know, in Australia, the first $18,000 of income that we earn, we don't pay any tax on that income. Actually, look at this. I've got it on the slide here. The first $18,000 that we earn, we pay 0% tax. Then on income from 18,200 up to 45,000, we pay 19 cents in every dollar, or 19% tax. 45,000 to 120 is 34.5%. 120 to 180 is 39%. 180 plus is 47%. These rates all include the Medicare levy, importantly. So really just as an FYI, and be aware if these look a little different to you. I don't know. Maybe you guys might be tax nerds like me and notice that these have actually changed recently. And this is one of the things that came through in the tax cuts in the most recent budget off the back of COVID. So there is a progression that's here. It means that everyone's now paying a bit less tax than they were last year. There's also the next stage of this is essentially eliminating the middle tax bracket, and we're going to be able to earn up to 180,000 without not paying any more than 39 cents in the dollar, which is pretty cool. What you should know, and one thing that confuses a lot of people when it comes to tax, is that there's no point on this scale where you earn more money and you earn a higher income and you end up with less money in your pocket after tax. Parking HECS and fee help, like loan repayments for a minute, because that can slightly complicate things. But I speak to a bunch of people and they'll say, oh, I got this pay rise, and they're worried about the fact that they're now getting paid a higher salary, but they're going to end up with less money in their pay. That's absolutely not the case. Because you're only paying tax on the amount above the new brackets, it can mean that if you go from a salary of $179,000 to $181,000, it does mean that your marginal tax rate here is going to increase from 39% to 47%. But what it doesn't mean is that 47% applies on any number below the $180,000. So the flow-on implications of that is that you're going to get, going from 179 to 181, is that you're going to earn an extra $1,000, which is taxed at 39%. So you're going to be $610 better off, and an extra $1,000 taxed at 47%. So you're going to be $530 better off there as well. Again, I hope that makes sense. I know it's sort of a bit hard explain without a whiteboard and pretty pictures. But know that getting a pay rise is always good. Getting a bonus is always good. Getting a commission check is always good. So marginal tax rate system, it drives it drives the amount of tax that we pay, and also be aware that you only get one tax scale in Australia, that there's only one tax rate, and that one for in your personal name. And I'm going to talk about tax entities like trusts and super funds and companies and stuff in a second. But in your personal name, you only get one tax scale for any rental or investment income, any dividend income, interest income that you get from the bank. They all add up with your salary income or any income from employment or any sole trader income. And then you get one assessable income number. That's the headline assessable income number that you see on your tax return. And that is the number against which the ATO don't care if you earn 100 grand from your salary and $10,000 from interest income and $20,000 from rental income. All they care about is that your total income is $130,000. So that's another thing that confuses some people, that they don't, they're sort of thinking that there is a different tax rate for different types of income. Not really the case. That being said, that there are different tax rates for different tax entities. And what I mean, like, an entity is basically just something with a tax file number, is probably a simplistic way to think about it. So every person, well, every taxpayer, at least in Australia, has a tax file number, and that tax file number is the ATO's reporting number against which all your income sits. With the super fund, which is the next thing that I've got on the list here, a super fund is its own tax entity. So a super fund has its own tax file number, and a super fund pays tax. You don't pay tax in your personal name on the money that your super fund earns. Your super fund pays money on that pays tax on that money. Then we've got proprietary limited companies, which is like PTY Ltd type companies, which is where you've got a business, or it might be an investment company. We'll talk a little bit more about some tax structures in a minute. For passive investment companies, so a company that's not an operating business, like a regular business, that pays a flat rate of tax. So it's not marginal. It's just every dollar of profit that sort of entity earns pays tax at 30%. For an operating business, there are some, depending on whether it's small, medium, or large, there are some different tax rates there are some discounts to the company tax rate that apply. But essentially, they're all fairly close to that 30% mark. Then you've got a trust, which is another tax entity, and a trust is a bit of a quirky one in that a trust does have a tax file number, but the key rule with the trust is that a trust never actually pays any tax, with a couple of really odd exceptions, which are super uncommon. But with a trust, like a discretionary trust or a family trust, which are essentially the same thing, well, that they are the same thing. It's pretty much that a trust is required to distribute all assessable income to another tax-paying entity. That's a key rule with trust, that it needs to distribute to an individual or to a company or like a charity or another tax-paying entity. So the different entities can have different tax rates, but within each entity, there's one set of tax rules that apply. We'll talk a little bit more about entities as we go through. So you only get one tax rate. Tax rates are different for different entities. And I mentioned before that for PAYG, and what I mean by this is employed individuals, like people that don't work for themselves, that investing is the biggest area that you can leverage to save tax. Investing strategies and strategies around investment, so buying property, debt recycling, those different sort of strategies, which I'm going to cover off in a little bit more detail. So in terms of investment tax, and I'll talk about the different types of investments, but I just want to give you some numbers as to why this is so important and why it's so important when you do invest that you get things right from the start. So what I've got an example here. And for anyone that's been following along with these sessions for a little while might have seen this one before, but bear with me. It's essentially as a refresher that it's got you starting with $0 today. So starting with $0 in your savings account or investment account, and you save $1,000 a month and invest that $1,000 a month into the share market. And I've got this 8.7% return, which is basically like the I'm spoiling the surprise here, which is basically the return on the share market over the last sort of like 50 years almost in Australia, as well as like a diversified international portfolio. So anyone that's not following along with the numbers, just pull me up if this is not making sense. But essentially saving $1,000 a day, so 12 months in the year, $12,000 over the year, over a 10-year period, then you've saved a total of $120,000. Hopefully that makes sense. But then over that 10-year period, you would have got some income, some interest income, dividends, these sorts of things, and you would have that. So now your money has compounded with the dividends to $190,000. You see then that over the next, and I've got the 20, 30, and 40 years here. So over each 10-year period, you put in another 120,000. So after 20 years, you put in 240,000, 30 years, 360,000, 40 years, 480,000. But you see that the compounding, the amount of the dividends and the growth and the upside on the shares or the investments is increasing over this period. So after 20 years, your 240,000 has now turned into somewhere in the order, if you've done this for the last 20 years, 642,000. After 30 years, your 360,000 has turned into 1.7 million, which is like almost a 5 times return. And then after 40 years, 4.2 million, which is almost a 10x return. So look, guys, you know, as you all know, that the past doesn't predict the future, and you know, there's no guarantees with this stuff, but you can see that it's pretty powerful. And this is not without taking a lot of risk. You don't have to be invested here in Afterpay or Zip or you know, some investment that shoots the lights out in order to get this sort of return. This is basically investing in the boring old market itself. And part of the reason is that was part of the reason for showing you these numbers, is to say to show you why it's so important to get your tax structuring right, because the difference between the tax on owning a $4 million investment portfolio in your personal name versus a trust structure versus a company versus a super fund, for example, is massive. Like we're talking about hundreds of thousands of dollars over time, and so you do need to get that one right. Mark's just jumped on and saying that was a bit of a tricky, a hard entry into the webinar, mate. I totally with you on that one. I see if you're coming in on that one cold, there are a lot of numbers there, but hopefully that can help to see the power of, you know, investing one, but also why it's so important that we need to be on top of our tax structuring and get that right from the start, because it is really difficult to unwind or restructure things from a tax perspective without, you know, realizing and dealing with a bunch of capital gains and associated taxes that sit alongside it. So that's the power of time. Look, the types of investments, and we'll talk a bit about each of these as we go through. We've got, you know, shares, managed funds, ETFs. I put them all in the same bucket. I've done a bunch of sessions. Look back for anyone that's interested on some of the previous sessions that I've done about investment basics, where I dive deeper into the nuanced sort of difference between those types of shares or equity type investments. But essentially for the purpose of today, we'll put them all in the same bucket. Then we've got property investments, your home, as well as other, you know, just general investments, super funds, and then we're going to talk a bit more about trusts. So for Australian shares, the expectation broadly, like when we do this financial modeling for people, when we're helping them with their financial planning, if we're trying to set some expectations around what a share portfolio would do over time, we generally use a 7% total return. Now you'll notice that 7% is a 1.5% and a bit less than the 8.7% long-term return that I mentioned. But when you're thinking about strategies, and I'm going to talk a little bit about planning with your money or planning with this stuff later on in the session today. But when you're thinking about planning, we want to always be slightly conservative, such that you're more likely to overshoot what you plan for than to do more poorly than expected, because you never want to be in a situation where you've banked on something happening and it's not come together that way. So if we are more conservative with our expectations, then when you overshoot what's there, then it's never going to really be a problem. So again, 7%, 4% income and 3% growth. Now, that income's important when it comes to Australian shares, because franked dividends, if anyone's heard that term before, but franking credits or franked dividends, it means that the tax has already been paid on that income. So it's like, if you think about the big banks that record their record profits every year, that CBA will make like a $5 billion profit, but CBA then pay the tax on that profit, and then they distribute the profit after tax, or at least part of the profit after tax, to their shareholders via dividends. Now, CBA has already paid tax on that money once, so that the government is nice enough to not tax us on it again. And in fact, we get a tax credit for the tax that CBA has paid on that money. So that is really helpful when it comes to investing, because you know that the tax has already been paid at 30%. And if we're then, we know that it's going to flick around, but going back to our marginal tax rates, that you're basically, even if your income's $180,000 or a couple of $100,000, and you're in the top marginal tax bracket of 47%, because the tax has already been paid at close to 30%, you only have to pay the top-up tax, the extra amount, which is significantly less than investing in, say, an international share that pays some dividend that you are then paying tax at 47%, which takes half of the money is essentially gone. So franked dividends make a big difference in the after-tax return that you receive on your investments. And that's with international shares. And when I say international shares, the biggest international market is the US. And in the US, a lot of companies, their income yield is significantly lower. So it's normally like 1 to 2%, as a contrasting to the 4% in Australia. And the same return, the overall return I would expect is still around that 7%. So it just means that the growth return is a bit higher. Because the franked dividends, though, only apply on Australian shares, because the government only cares about the tax that's being paid by companies in Australia. So franked dividends, good. ETFs, or exchange traded funds, give you slightly more control over the tax purposes. And again, it's probably a little bit beyond what we'll cover today, but with an exchange traded fund or an ETF, you actually own a tiny little sliver of each share. So if you own an Australian share market ETF, you're going to own a tiny piece of each company that's listed in Australia. And so long as you don't sell your ETF, that there's no capital gain on that part, on the part of the share that you own. Whereas with like a managed fund, for example, and I think the ETFs, that's why they use those fractional ETFs to allow that extra control over from a tax perspective. When you invest in a managed fund, by contrast, then you're investing with a big pool of people, and if someone wants to take their money out, then they sell the shares and capital gains gets realized. Again, it gets pretty technical, but there is a difference between the two. So understanding which investments are going to be right for you, especially as the amount of money that you've got builds, it will make a significant difference. And the other thing, or the last point that's on this slide, and probably one of the most important ones when it comes to shares, is where you should hold the shares. Do you own them in your personal name? Do you own them in a trust? Do you own them in a company? Do you own them in your super fund? Different tax implications of all of them. And I'll talk a little bit more about how we plan around that and plan smart with that as we go through today. Property. Now, property has a few benefits. The first one that I've got here, and this is not necessarily a tax benefit, but is the benefit of gearing when it comes to property. So actually, gearing just means borrowing money to invest. So when you buy a property, you generally put in a deposit, then go borrow some money, and you gear up essentially to then go and buy this bigger property. And you once you do that, you've got this big asset working for you, and it's very hard for a non-geared share portfolio, or if you say we use a $200,000 deposit to buy $1 million property, it's very hard for a $200,000 share portfolio to compete with $1 million property, even if it's a great share portfolio. So the gearing benefit is one of the biggest benefits of buying property. Investing as an owner-occupied versus an investment for a property has different tax implications. One of them allows you to claim negative gearing, which is if you buy a property for the purposes of investments, if the mortgage repayments and the ongoing property costs, or the mortgage interest repayments at least, and the ongoing property costs are less than the rental income that you receive, the shortfall, the difference between the two is negative, and you're able to claim a tax deduction for that, what's called negative gearing. The tax deduction can be used to offset the income. So if your negative gearing amount is $10,000 and your income's $200,000, then it brings your income down by the negatively geared, or the negative amount on the property. So you only pay taxes if your income is $190,000 in that case. And then the other thing with property is you can get some really good deductions, because all of the management costs, the maintenance costs on the property end up being deductible to you personally. You also get, if you buy interstate, you get the benefit of being able to have a couple of trips interstate to check on your property each year, which you can claim as a tax deduction, which is cool. And it allows you to sort of, again, add into that negative gearing benefit. If that's what happens, then you end up able to claim a tax deduction for that, or reduce down your taxable income. There is also the potential to be able to do a debt recycling strategy with an owner-occupied property, and what that means is paying down your mortgage debt at the same time as investing via a debt cycle. So to put it in a practical example, let's say you have a $500,000 mortgage. If you've got a $100,000 share portfolio, you could pay it. You could sell the portfolio, pay the mortgage down to $400,000. You draw another $100,000 from a separate loan, and then, or you could even do it from the same loan, although it gets a little bit complicated from an admin perspective. And then if you invest that money, because the purpose of that debt is to invest, then you're able to claim a portion of the interest on the debt as well, the interest that relates to the investments as a deductible benefit, because it's for investment purposes. Now that only works if it's only worthwhile if the property is your own home, because in your own home you're unable to claim a tax deduction for the interest that you pay. The next one is super, and the tax in super is that all income in super, so interest income, dividend income, etc., is taxed at a flat rate of 15% in super. The capital gains in super are taxed at 15% or at 10% if you have if you've held the investment for longer than 12 months. But obviously super, and you can see from these numbers that super is significantly has got significantly lower tax rates than personal name. But the problem with the investing in super is that your money ends up trapped in super. So we've got to balance the benefits there. Guys, I can see a few questions coming through in the comments tab. I am going to circle back to questions. I'll do a little bit as we go through, but more towards the end. But if you could just please, there's a lot of stuff coming through in the chat. If you could just put them directly into the Q&A box, that'll make sure that they're less likely to get missed. Next one here, trusts. So the key rule with trusts, and what I mean by discretionary trust is a trust that where you have discretion as to how to distribute the income. And basically the rule, as I mentioned before, the key rule with the trust is that you're required to distribute every single dollar of assessable income that a trust earns to another tax-paying entity. So you can distribute to an individual, you can distribute to a company or an investment company or an operating company, although that's less common. You can distribute to like a super fund or a charity or something. So someone else has to pay the tax. Now, trust, the reason that that's beneficial is if you think about creating assets or growing assets or a portfolio of assets, that are going to grow your wealth over time and allow you to basically build an investment income that will reduce your reliance on your employment income, or essentially mean that you're financially free because you've got an income coming through that's not linked to your employment, then the expectation is that the portfolio of assets is going to be, at some point, you're going to structure it in a way to deliver you a passive income or an investment income. Now, if you imagine the scenario where you are receiving an investment income of $100,000 a year, if an individual receives an investment income of $100,000 a year, if that's their only source of income, you'll pay tax on, you'll have an assessable income of 100 grand and you'll pay taxes if you earn 100 grand. Pretty straightforward, right? But if you have that 100,000 and you split across two people, like yourself and your partner, for example, or yourself and three people, yourself and an adult child in the future or whatever, you see that we're using multiple tax rates now. So we're using different tax rates, which means that we end up with more, with a lower effective tax rate on the income. So it can save a massive amount. And also with capital gains, you know, if you think about buying a property, say $1 million property, and you want to invest in it for 10 or 20 years, property, the rough rule of thumb in Australia is a property tends to double, at least for the last sort of 100 years, double every 10 years. So if you buy $1 million property, in 20 years time, it should be worth somewhere around $4 million. Now, if you sell that property, you're going to have a $3 million capital gain. Whereas if you can distribute that at least across a couple of people, you're literally saving tens of thousands of dollars in tax. If you can distribute it across more people, you're going to save even more money in tax. So the tax savings can be enormous over time. But and what I've got here is that there are some costs to operate a trust. You know, you need to set it up. That's a $2,000 or $3,000 exercise. Set up the company, set up the tax file number, get it all registered. You got to do your tax return each year. There's some compliance costs in that. You know, a few $100 to $1,000 depending on how much your accountant charges or the accountant that you find charges. Cost to do that. There is also some land tax implications that trusts don't get the land tax exemption that individuals get on investment properties. So that's something to be aware of. And they can, it's worth looking into if you're looking at going down this path. It means that it's not just a cut and dry decision. That you can also use with trust in investment company to receive the assessable income. That's a common strategy for people that are really trying to crank their asset building and wealth creation. And in doing that, because your investment company has a flat rate of tax of 30%, it means that while you're growing your assets, that you never have to pay more than 30% tax on your investment income or growth unless you want to spend the money. Which means that it could be, you know, especially if you got a bunch of money, the more money you've got, I suppose, the more attractive this sort of strategy becomes. There are some really technical things that you need to get right. And if you're looking at going down this path, please get some good advice to make sure you're doing the right thing. But it means that you're saving tens of thousands. When we look at this and quantify it for clients, it's typically savings in the order of, you know, tens of thousands, sometimes even in six figures. So worth thinking about. Then, oh yes, I've got that here. So, and when this sort of setup becomes starts to even get on your radar is if you've got at least six figures for, like, as in $100,000 plus investment portfolio, or you're saving really strongly. So you're saving like $5,000 or more a month. Or you've got a big chunk to invest, then you want to at least be asking the question. Not to say it's always the right thing to do, but it's worth asking the question and understanding whether it might be the right move for you. So guys, I'm going to jump into some tax strategies now, some things that you can do. Negative gearing, I already spoke about. So that's where you buy a property, and if the debt is high, and like when you're generally earlier on in a property purchase, then having negative gearing is something that reduces your assessable income, essentially. Deductions is something that's important. It can be overlooked, making sure that you're claiming for your home office expenses, work-related travel, stuff that's specific to your work. The ATO's website is really, really helpful for the things that you can claim, so I'd encourage you to get that right. keep good records. And I've probably got this in a future slide, but where a lot of people go wrong is that they don't keep good records, and they'll go see an accountant, towards the end of the financial year or after the financial year is finished and say, hey, what can I claim as deductions? The best time to start thinking about your tax planning, apart from right now, is the 1st of July, like the start of the tax year, because then you can start keeping your deductions, know what your tax strategy is, and it means that you're going to be able to keep good records to get the most deductions possible. Next one is offset versus redraw. There is a difference from that from a tax, from an ATO's point of view in terms of what interest is deductible and what interest isn't. Where a lot of people go wrong is that they'll buy a property. You might buy a stepping stone property as your first home or subsequent home, a property that you're buying to get to get or to stay into the property market, but with an ultimate view to buying a dream home in the future that's a bigger or has more space or in a different location or whatever. Now, if you pay down the mortgage on that debt and then move out of the property in the future, because the debt is really low, if you rent the property out, the rent's going to be more than the mortgage repayments, and then you have to pay tax on the positively geared amount. So if you do that, then you end up with a bit of a tax issue. Whereas because you need to fund the dream home purchase, that you can if you redraw against the property to buy your dream home, that's fine. But because the purpose of that redraw is to buy your dream home, again, you don't get a tax deduction for that amount. On the other hand, if you were to use an offset account, you put money into the offset account. Then when you go to buy your dream home, you simply take the money out of the offset account, use that as the deposit for the dream home. Your debt has never changed on that property. And so if you start renting it out, your debt is preserved, and therefore your deductions are higher, and therefore you have less of a tax issue to pay. So it's a weird quirk, but it is one that I see a lot of people cost themselves, tens of thousands of dollars each year, because you get emotionally attached to these properties. You don't want to sell it, or it's a good property. That's why you bought it in the first place, but it ends up being a tax problem and just a suboptimal outcome. Franking credits I mentioned before. So when you're investing in shares and ETFs and stuff, if you use investments that have franking credits attached to the income, then that's part of the tax, or a big part of the tax can already be paid, means that you pay less. Private health insurance is something that a lot of people don't think about, that if your income's above a certain level, it's somewhere around the 100K, I think, at the moment, and you don't have private health insurance, then you pay an extra 1% of your income in tax. So if you're paying an extra $1,000 a year in tax, that generally the health insurance is around that sort of cost, or maybe less than that. So you can either get health insurance for free, or in some cases, if you're on like a couple of $100,000 income, you're actually getting paid to have health insurance in place. So definitely worth making sure you're on top of that. The other thing that you should think about is leveraging the ATO timeline. So long as you have a tax accountant, as long as you're on the register for a tax accountant, the last day to lodge your tax return is in May. And that means that you have until, if you've got a tax bill, if you've got a tax refund, obviously you want to get that refund, get the money back into your bank account. But if you're getting a tax bill, then you can wait until that time, and it means that you end up, you can sit on the money for longer instead of the money just sitting in the ATO's bank account, which to me is a more favorable outcome in your bank account. I mean, planning, and I mentioned I've probably had this already, but planning in July, April for the end of the financial year, but then July for the next financial year, knowing that you're doing the right things and making the most, all set to make the most of your tax position in that year. Deductions, some of the deductions that you can claim and think about towards the end of the financial year: prepaying expenses and interest. So if you're paying expenses, say for an investment property, you could get on the front foot with your maintenance or whatever, or property managers costs, or interest payments on the debt as well. Making sure you're keeping good records, and financial advice, income protection. Sorry, I probably should have put that on there as well. Income replacement insurance is tax deductible. Financial advice, look, I'm not allowed to say that it's deductible. Am I allowed to do that on a webinar? I'm not sure. But if you're getting financial advice about building investment income, then that's generally deductible as well. So that can all help. Plus, it means that you're getting sometimes up to a 50% discount to get the advice to actually build your income and assets and stuff faster. Which obviously I'm totally biased because that's what we do, but have found that's pretty helpful in getting ahead. Mistakes people make around tax: not planning before you invest. People just do stuff. You listen to that Reddit thread, or your mates or colleagues or parents, even worse, and you do a bunch of stuff, and then if you're missing the opportunity then to make sure that things are structured in the right way. So tax plan before you invest, and then you'll know that that things are set up in the optimal way. Never, this is sort of a personal view, but in my opinion, never invest for tax purposes alone. Now, this is common in the property space. You see these off the plan properties, big depreciation benefits, all this stuff, these crocodile shoe wearing property spruikers that tell you to, talk about these positive cash flow properties and, that you should make all this money and it doesn't cost you anything. If you're investing for tax purposes alone, if the tax rules change, and there was talk of that in the recent election, maybe that will come up again in the future, that if the tax rules go away, then you can end up with a substandard investment and mean that it was never really a good investment in the first place. So don't invest for tax purposes alone. An investment should stack up on its own without the tax benefits. The tax benefits should be it should be the cream on top, not the reason that you're doing the investment. Not keeping good records, I've mentioned a couple of times, so make sure you get your shoebox or your digital shoebox these days. And yeah, advice with an agenda, whether, a lot of, when it comes to tax stuff, financial advice, or the property stuff that I mentioned before, can really throw things out. So don't find someone that their agenda is making sure that you're super happy. And how you do that is working with people that aren't getting conflicted benefits. So like fee for service professionals, tax accountants. It's hard if tax accountants are recommending trusts and self-managed super funds and this sort of stuff, because you know that they're clipping the ticket. So if that's the case, get a second opinion from someone that's not financially motivated by you going down a particular pathway. It's going to mean that you can just stress test and make sure that you're doing the actual right thing. Thinking that there's a set and forget strategy is another mistake that I see. Unfortunately, these days, everything is just changing so quickly that you need to make sure there are three things that you always need to make sure are consistent with the plan that you've set for yourself. The first is what you want and how you feel about stuff. That changes pretty quickly. I don't know about you guys, but I noticed that from myself and the people we work with, that those things change. The second is what's going on with your money and your finances. And the third is what's going on in investment markets and the world, like the tax rules, the tax legislation, investment markets, property markets, what's happening in the world, COVID disruption, all this stuff. So you need to make sure that those three things remain consistent with the plan and strategy that you've set for yourself. I'm going to talk a little bit more about how you can plan in a second. But if any one of them changes, you need to change your plan, essentially. And then going it alone, when it comes to this stuff, it's really hard. Tax is one thing as well. It's a minefield. It's pretty complicated, but I still see so many people that are doing this all themselves. Part of why that is because it is really hard to find good tax accountants for PAYG individuals, unfortunately. But doing it all alone is really hard. You end up falling victim to your psychology. You're chasing your tail, that FOMO and the FOFU. You don't end up taking advantage of opportunities and less confidence to be aggressive when needed. Now, that can partly relate to tax, but really I'm talking about more broadly when it comes to your money, that there's so much benefit in having the right people to support your decision so that you're not trying to figure it out all on your own. Obviously, it saves you time and gives you confidence, but there's a lot of financial benefits in doing that as well. So think about building your dream team of the professionals, mortgage broker, accountant, financial planner, insurance people, to make sure that when you need support or when there's benefit in getting support, that you've got it on tap. So next steps, and I just want to talk about how to actually plan with your money. You can apply this to planning with tax, but it's as well as more broadly with your money. That key steps to go through when it comes to stuff. Look, this is the process that we step people through when helping with their financial planning, but it's essentially the same steps that everybody needs to follow if you're looking to plan with your money. That essentially first thing is focusing on what's important to you. Then what's important, what's on the hit list, what's not working the way that we want it to. Then to set up a plan, you need to understand all the moving parts and the things that are going to impact your plan. Also clarify that lifestyle baseline that you want to make sure that you have the ability to do if you choose to do that. So making sure that you've got those things to fit with the financial decisions that you want to make, as well as unpacking the scenarios that you'd thought about. It might be, negatively gearing property, buying your own home, building an investment portfolio, whatever the case may be. Then you want to explore some strategies, some options, and the way that, in my view, you should be doing this is to say, look at the numbers and what do the numbers tell you? What is if you buy your own home versus an investment property versus build a share portfolio, what is the difference in financial outcomes that you can expect? Then think through, and you need to build your knowledge around what's not in the numbers. Where are we comfortable? Where are we stretched? Where can we probably push a bit harder? Then once you've set the strategy, we need to put it into an action plan. So bullet point out, what are the 27 steps that need to happen to turn your great plan into great outcomes? From there, automating as much as possible, automating your saving strategy, investment strategy, tax planning, debt reduction, whatever those things are. And then 6 is the ongoing review and execution. So you can't skip any of those steps. The strategy is really the centerpiece, but in order to get there, you need to make sure that we're rock solid on all of the inputs. And then once you've got a great strategy, you need the plan and the automation to turn it into great outcomes. So a bit more on that there. I'll show you, I've got some resources to share into how you can start to apply this for you guys once I just wrap with going through the different money stages and the hacks that you can use to progress through the stages. And what this comes about from the fact that I've found that, when it comes to money, there are 4 stages that people go through, and some key things that you can do to progress between the stages. Now, the stages range essentially from really bad to really good. And there are 3 things that typify where you're at with the stages. The first is what's going on with your money. The second is how you're feeling. And the third is how quickly you're getting ahead. So for people, this first stage, people in the distress stage, that's you're stressed out, you're making no financial progress, or maybe even going backwards in some cases, understandably stressed out as a result, and you've got no options. You're feeling trapped from a personal point of view because you've got no money to do the personal stuff that you want to do. Now, you can't get out of that stage without making a commitment to your finances. And you guys watching along have all made a commitment today to taking the time to do this. So well done. It's not something that happens on its own. It's important. Money's important, but not urgent. So you need to firstly commit. The next stage is stalled. And for people in the stalled stage, that's where they're making some financial progress, but it's slow and slower than how it would likely to be. There is the ability to make some of the personal or lifestyle choices that you want, but they generally come at the sacrifice of getting ahead at the rate that you want. And from a peace of mind point of view, you're not fully stressed out, but you've just got that niggling thought in your back of your mind that there's something that you're missing out on, something more that you could be getting with what you've got. I'll show you how we get out of that stage in a sec. Now, the third stage here is comfortable. And for people in the comfortable stage, that's where you're now starting to get some really solid traction from a financial perspective, finding a nice balance between getting ahead financially and living an awesome lifestyle and feeling really confident, building a confidence internally. The fourth stage is what I very technically call the killing it stage. And for people in the killing it stage, that's when you're now making really rapid acceleration from a financial perspective, that you've got no limits on the personal or lifestyle things that you want to do, that you're able to do. And from a peace of mind point of view, you're feeling completely carefree. So I wonder if anyone's open to sharing. I'd love to know if anyone can identify with any of the stages that are there. But as I say, you can pop that into the chat. As I say, it is a progression, and there's some key things that you can do to get through the stages. The first is making that commitment to get from the stalled stage to comfortable. You need to be taking ongoing action. You need to do stuff, and you need to be able to. You need to do it on an ongoing basis. I see a bunch of people coming through. I think stalled seems to be the predominant sort of winner here as well. But yeah, so getting out of that stalled stage is all about taking ongoing action. Comfortable is the key to getting from the comfortable to the killing it stage is maximizing all of the opportunities available to you. So basically making sure you're taking advantage, that you're optimized from a tax perspective, doing the right thing with your investments, your debts, and that compounds how quickly you get ahead, and compounds how quickly you build your money momentum. So as I say, progression to get through the stages, but there are some key things that you can do to push things forward. And I think for you guys, like I say, well done. You've got taking a good start with getting involved today, but now we need to translate that into taking action and getting results. And I'm just going to leave you with this quote from Derek Sivers. He's a total legend. He talks about the fact that more information is not the answer, that the key to getting results is taking action. He's saying if more information was the answer, we'd all be billionaires with perfect abs. And it's so true that we need know how to do this stuff, or we know what we need to do. It's just a matter of putting it into practice. So I would encourage you. I've found that knowledge is a key to taking action, and that focused knowledge is the key to moving it forward. So guys, I'm going to leave you with that. Just before I do, though, for anyone that wants a bit of a hand to take the next step, we run these 45-minute one-on-one breakthrough sessions where basically clarify what your money opportunities are, what are the roadblocks that you can clear, the things that are low-hanging fruit or things that are going to make the biggest impact on how quickly you can get ahead. I put a special link here, which is discounted to $195 for the people that are online today. We donate 100% of this money to charity, actually, and I'm super pumped. Last year we raised 20 grand for charity through doing these sessions that we donate our time. You put in a bit of cash, everybody wins. So if you're interested in getting involved, these sessions are perfect for people. If you're saving a decent clip monthly, you have a chunk of cash to invest or some decent equity in your property, or if you're working in techs with restricted stock plans or employee share purchase plans, that sort of stuff. The link is there. I put the link into the chat box for everybody as well. I'll just pop that there again so that you can get that. And yeah, basically helping you to push forward. So feel free to check that out. Love to get you involved. Also help us raise a bit of cash and learn some stuff about money at the same time. I put in like 15 slots or something over the next couple of weeks. If you want to get involved, you can book through there. Rika says, is the $195 tax deductible? That's a great question. I'm not allowed to say yes, but I can introduce you to an accountant that will say yes as well. So I'll leave that up there, but I am just going to jump into the Q&A. For anyone that has any questions, feel free to pop them in. I can see that there's a bunch of stuff on there as well, so I'll do my best to get through them. The first one here is saying, is there a minimum amount that a debt recycling strategy should focus on to make it worthwhile? I understand that you want to recoup the cost of the loan restructuring fees outperforming the applicable interest rate and some provisions for greater complexity in sorting out your tax affairs. Yeah, look, I don't know. It depends on how you're going to do it over time. So if you've got the ability to, even if you're starting small, if it's something that's going to be a focus over time, I'd say that there's probably no minimum. But yes, if you're going to do, $1,000 a year for the first 5 years, it's probably less likely to be worth it. But yeah, I'd say on a regular investment. For people, I've been getting a lot of questions about debt recycling lately. I think because I've been talking quite a lot about it in the current environment, it's a really great strategy. But if you're thinking about going down that path, I would strongly encourage you to get advice, because there are some quirks and complexities that you don't want to muck up that can take away from the benefits that you get. So reach out to somebody. Anyone that's interested, you can drop us a line as well on the Pivot Wealth website, which is pivotwealth.com.au. There's a contact bar there as well. So I've got, does PAYG investing reduce tax? I don't really understand that question, but investing as an individual, PAYG just means that you pay as you go tax. So it means that you're an employee individual. So if you could put clarification, happy to do that. Anonymous says, where do you buy ETFs? Where do you buy ETFs? Go through your stockbroker, CommSec, or do you need to get someone specific like Vanguard? No, so CommSec allows you, that's a good question, that CommSec is a platform on which you can buy ETFs, but ETFs are managed by people like Vanguard. So Vanguard is the product, CommSec is the platform. So you need to use a platform to purchase, like a stockbroker, an online stockbroker like CommSec or another one, and then you need to find Vanguard BetaShares, like the provider to actually manage the investment. Marlene says, does negative gearing only apply to investment properties? Yes, that's the case. Yes, you don't get any interest, Marlene, on interest payments on a home loan. So it's only for investment property. Got a question here about explaining the definition of a capital gain. That's a good question. And sorry, I probably should have put that in there. I suppose that the capital gain is the difference between the price that you pay for an investment and how much you sell it for. So if you buy a share for $10 and sell it for $20, The difference between those two numbers, the $10, is the capital gain. If you buy a property for $500,000, sell it for $600,000, the difference between those two numbers is the capital gain. For individuals, if you've held an investment for longer than 12 months, you get a 50% discount on the capital gains tax that you pay. So that helps as well. Gutam says, if I use equity in my current owner-occupied house to buy a second house that becomes owner-occupied and the current property becomes an investment property, can I still use the access equity for debt recycling or for negative gearing? Well, if you borrow against your old house for the purpose of buying a new house, that would mean that that debt is not tax deductible, but the debt that's on your old house that was used to purchase the original house, that would now be investment purposes debt and would be deductible. I hope that makes sense. Ansay says that I thought deduction claims for trip costs to your investment property was banned a while ago. I don't believe that's the case. I think you still get 2 trips a year from my understanding, but I'm not a tax accountant, so please do confirm that with a tax accountant. Caleb, yes, good pickup. You understand profits can be retained in a trust, and the tax rate payable would be 45%. That is 100% true. It's just that doesn't actually make sense to do that. So I don't know why you would, when you could just distribute it to yourself and then you have the investments outside of your trust, then you can recontribute it to the trust. Gets pretty technical, but yeah, good pickup. That was one of the quirks that I was talking about. Joe and Millie, repeat the investment property investment section. Sorry, I'm not sure specifically what you mean. If you want to just clarify that, happy to do my best there. A couple more questions just before we wrap up. Erwin says, if I bought a $1 million house, sold it at $3 million and want to buy a $3 million house, do I get tax first on my $2 million capital gain and therefore unable to buy the $3 million house? Well, look, if you're buying a home, if you live in a home, then there is no capital gains tax. That only applies to investments. So your home is CGT free. But if you have an investment property that goes up and you make a $2 million gain, yes, unfortunately, you do pay tax on that gain. Investing newbies, what sort of investment do you recommend to be a great place to start? Look, I can't make any recommendations without jumping through a whole bunch of compliance hoops, because that's how the compliance stuff works. But I would say that, you know, there are a number of these fractional investing or places that you can start with a very low balance. Raise is one of them, the guys that we're doing this session in partnership with. So that's probably something to look at, or look at the comparison sites like a CanStar or Finder and that sort of stuff that give you some platforms as well. CommSec is one, Self-Wealth, CommSec Pocket. There's a bunch of ones that are lower. You want them to be lower cost and allow you to fractionally invest. So yeah, check out Raise is a good place to start, I think. Index funds, a good idea for tax purposes. Yes, they can be. Depends on the index fund. So we just got a comment there, say superhero is good for starting. I've not heard of superhero, but thank you for that, Zach. Are investment funds good for tax purposes? Yes, they can be. Yeah, it depends on the type of index fund that you use. I'm just going to take one last question. At what LVR on your principal place of residence would you recommend to begin debt recycling? Well, look, you need to be below 80% to avoid paying lender's mortgage insurance. So that's a good sort of barrier there. Doing that, yeah, we'll make sure, because if you're paying lender's mortgage insurance, it starts to not make a lot of sense. So guys, look, there's a bunch of questions and well done. Appreciate the enthusiasm there. We're going to send around a note off the back of today. I'll send one over with the link to these sessions for anyone that wants to get involved. If you've got any questions, you can reply to that email, or you can drop us a note through the Pivot Wealth website. And check out, I've got upcoming events. I'll send them through as well. But there's 2 more events in this series coming up in a couple of weeks' time. Get involved, and yeah, well done for General Assembly for putting this on, and the champions at Raise Invest as well. Thank you, guys. I will see you